Explore the history, relationships, expertise, and data that go into ensuring Stine growers get maximum yield potential. This is the Stine Seedcast. Here's your host, David Thompson.
Hello, and welcome to the Stine Seedcast. I'm your host, David Thompson, National Marketing and Sales Director for Stine Seed Company. We've got another great episode lined up with special guests, expert insights, and discussion on everything you need to know about maximizing yield potential. On today's episode, our special guest is David O'Malley, Manager of Aftermarket and Agribusiness Financial Solutions with John Deere Financial. Welcome to the show, David.
Good morning.
So today we're excited to have David on the show to discuss the latest economic trends and how that's going to impact growers' interest rates and growers' purchasing power in the year to come. So let's get started. So David, as we get started here, I wondered if you just give us a little bit of background about yourself.
Good morning. David O'Malley from Madison, Wisconsin here today. A little bit about my background. I grew up in southeast Kansas, so I grew up in kind of the rural agricultural setting, actually family owned and operated John Deere dealerships down in that part of the country. But I've been with John Deere Financial for over 25 years within the financial services space. So I have quite a bit of experience around lending, financial products and services for our ag producers.
Okay. Awesome. Thank you. So today I want to talk a little bit about, the financial side of the business as it relates to seed and crop protection, all the things that come with it. And certainly it seems like in agriculture, we're undergoing a pretty significant shift in finances and in the market space. So wondered if you'd kind of give us an overview of how that's changed over the last year or two, particularly with respect to interest rates.
Yes, we've been spoiled, quite frankly, over the last 10 years or so with low interest rates. And really over the last 18 months, really since the, coming out of the pandemic, we've seen a dramatic shift in interest rates that really impact the end-use customers and our consumers at the retail level. So, really, if you take a step back just over the last 18 months, our prime rate, which is a kind of a key index for us when we're borrowing on the retail market, was at 3.25% in March of 2022. That prime interest rate today, as we sit, is at 8.5% here in, I guess we're in November. So this is a result of the Federal Reserve's aggressive efforts to combat inflation, which was on a tear there for a while. It's since come down. We can talk about that in a little bit around the inflation print here this morning. So, we were at a peak at a 40-year high of 9.1% inflation in June of 2023. So significant increases in prime rate interest rates as a result of historically high inflation, really that peaked in June of 2023. And if you take a look back, there was 11 interest rates hikes by the Federal Reserve since March of 2020. Really bringing it to its highest levels in 22 years. So that really leads to more expensive borrowing costs for ag producers, and it really has a significant impact on their businesses.
So, yeah, and I think definitely want to talk about what that means for the grower. I guess you mentioned this is really kind of taken place over the last 18 months or so. Wondering, what are the converging factors here that are causing this increase? What are we talking about? Global issues? Are we talking about, issues here at home? What are some of the factors that are leading to this change?
Right. Well, I think I think something everybody can connect to would be, the pandemic and during COVID. I mean, the world was impacted by that. I think probably everybody understands a little bit of economics 101, supply and demand. So, the whole world shut down really caused significant impact on supply chains and disruptions there. So there was less product, less goods and services in the market flowing. So when you have less in the market and you still have the same demand, prices will go up. And that's exactly what happened really across the globe, even well beyond the U.S. here. So high inflation was really the key global driver, which led to, as well as strong economic growth. So those two things are kind of work against each other. When you have high inflation and you have strong economic growth, there's a point in which She can't tolerate that. So the Federal Reserve and global economies need to combat inflation.
Yeah, and I think inflation is something that, most everybody can relate to, whether you're, a consumer of any kind. So that's obviously the most outwardly visible symptom. Are there any other, I guess I'm curious how this change in the prime rate and associated interest rates ultimately impacts a grower's, purchasing power in the immediate short term?
Right. It's a great question. It does, and it does pretty on a significant level. So, our farmer producer growers, they have operating costs. So everything from land to equipment to their crop input, seed, fertilizer, crop protection, that costs money, and all those costs have went up. And then you layer on top of that our ag producers rely upon lending and operating loans. They borrow money for their season, and those costs have gone up significantly. So you think about, what an operating line of credit looked like a couple of years ago versus what it is to now. It's at prime or above, which is, in the 8% range. So that's significant cost differences and significant interest expenses that they didn't have to deal with a couple of years ago to this degree. So a farmer who borrows $100,000 and today or for the season would have to pay $8,500 in interest expense right now for this season at 8.5% prime. That was up from $3,200, just the year before. And farmers typically borrow a lot more than $100,000. So a $500,000 operating loan, that is $42,000 in interest expense now versus $16,000. So the difference between $16,000 and $42,000, that's the difference, where that's just additional operating costs and impacts on a grower's profitability. So that's a significant point. And then I guess in terms of your last question around trends impacting growers' ability to secure operating loans, the trend is that rising interest rates is having an impact in making it more challenging on banks as well as farmers to secure their financing and operating loans for that season. So the good thing about agriculture though is it's definitely a big community. So it's not like other industries where lenders take off and are not around. Ag lenders hang in there, and so it is more challenging, but there's still a lot of available credit and financing out there to be had. But it certainly does impact rates, costs, terms, things of that nature for an ag producer to secure those annual operating.
So then drilling down a little bit more specifically with respect to, your company, John Deere Financial, I guess I'm curious how John Deere Financial has been.
Well, I guess John Deere Financial as a whole, it's probably a well-known brand, maybe one of the more trusted brands in agriculture, and certainly our lending arm of John Deere Financial has been around for a long time. The product line that I'm associated with is called, we do a lot of agribusiness retail financing for crop inputs. So seed, crop protection, fertilizer products within a product we call multi-use account, used to be called Farm Plan. So we've been in this business for a long time. Actually, we're going to be celebrating 50 years of supporting farmers with this product line here next year in 2024. But nothing has changed from our point. We're here. We've been here during good times and bad. We've been doing this for decades. We work with some of the top companies like you, as well as major seed and crop protection manufacturers and crop life top 100 retailers and seed companies. So we actually provide a service where these companies, they have a goal to sell more product. They realize financing and paying for that product is a significant part of their value proposition. We're able to work with these companies and they can sponsor programs like low rates or 0% or 1.9 rates. And during times like the season we're entering into, as well as the season we're just finishing up, those lower interest rates versus what a grower's prime rate really add significant value to our ag producers and allowing them to save money. For example, some of the programs that we have could, just on $100,000 crop input purchase could save a grower today over $12,000 versus what type of lending or what their operating line of credit would give them at the bank. A 1.9% rate today would actually save that grower a little over $9,000 in interest expense for that season. And that's just with a $100,000 increment. So a lot of buy now, pay later. We have a program called Harvest Terms, which allows a grower to actually secure their seed right now or crop protection, and they won't have to pay for it until after next season's harvest. So, hence the harvest term. So it'd be due in November, December of 2024. So we provide a lot of cash flow friendly interest expense saving solutions that really fit that ag producer's season and business and allow them to farm and produce on their terms. And we feel that's a good fit for them.
Yeah, and that's a great point. You're talking about, meeting cash flow needs or, pay after harvest. And I know we have some great options available through financing with Deere for, again, basically a December pay, depending on, when you come in and at what level you come in, different terms. But that is a big help, I think, flexibility-wise for growers who are trying to figure out their cash flow. Curious about, in this market that we're in now, are there things that growers can do or should be doing, between talking to their bank, talking to their lender, whether it be John Deere Financial or otherwise? Are there things that they should be looking at to help them kind of make sure they're getting the lowest interest rate possible, keeping their exposure kind of as low as possible for the coming season?
You bet. It's a great question. Yeah, there's a number of things that they can do. Really, I think the first would be, looking beyond their traditional operating loan or their local bank. And because there's a lot of options out there, third-party lenders like ourselves, we would fall within that third-party lender group. There's a lot of companies like us that offer solutions that are fit the ag producers' business model, that are offering very competitive rates that are typically lower than what they can actually get their local bank. So I would say, diversify your capital needs, look for other sources of lending. Don't put all your eggs in one basket. But there's a lot of programs out there. And, actually, you can actually go look at inputfinance.com, which is a site which will allow that grower to go look at what programs are out there by the local retailer.
David, as we're talking about growers trying to make their plans, again, they may be deciding with interest rates where they are, are they going to pull from an operating loan? Are they going to draw from some reserves or look at a full-on financing option? I guess, what are the considerations or how do they need to weigh those options as they're thinking about that?
There's a lot of schools of thought on this. It's a great discussion to have. We get into it quite a bit. Always there's the analogy, well, cash is king, right? I have the cash, I should just pay cash. And we like to challenge that thought, especially in times like this, where we believe cash is not always the best solution to make your purchases with. If you can get, preserve your cash, put your cash on the sidelines or put it to work with a money market account or a CD, which are paying incredible rates right now. We're seeing short-term CD money as well as money markets in that 3 to 5% range. You can get that quite a bit anywhere. That's a great return on your money. If you also preserving your cash for unexpected costs that might come up or opportunistic opportunities for your farming operations is always a good thing. But also when you can get into maybe paying for your seed or your crop protection this year at like a 1.9% interest rate, which you're offering, and that might be a better deal for you to take advantage of that financing, where that's a lot better than your operating loan at a bank, which could be 8%. So it's really just looking around the landscape and seeing what's the best fit for my operation, what's the best use of my capital, and really looking at those opportunities. We see a lot of growers who have been using this strategy around not just paying cash for everything, but really taking advantage of some of these attractive programs where they can get cheap money that will save them money over their operating loan. I think there's a lot of folks that say, well, I just pay cash, but they're actually they're writing a check off their operating loan too. So really just looking around and doing the math. And it's easier than ever before. We've got a calculator that a grower can go and kind of personalize their experience, which is inputfinancecalc.com. And they can actually enter in their purchases and select the program and interest rate and term, and they can actually see, how much interest expense savings could I have here? And they can actually factor in a cash discount on top of that too to see, is the cash discount a better deal versus the financing? So I would just say, there's a lot of scenarios and options. And in times like this with CDs and money market rates, as well as opportunistic stuff that's going on in agriculture, might be best to really use that cash for other purposes.
Yeah, so at the end of the day, it's really a simple matter of figuring out where's that money going to go to work for you better. Again, you've got that cash reserve, but if you can make it work for you through other means, like you said, money market, CDs, whatever, and if you can get available cash for, in our case right now, we're looking at 1.9% financing. That might be a better deal to swing that and let your money go to work somewhere else, so they've got options, right?
Right. Yeah, that specific 1.9% offer for your seed will save a grower over $9,000 in interest expense this season versus using their operating loan. So that's a clear value right there, no matter how you look.
Yeah, great point. Thank you. So, David, as we talked about this big shift that's happened over the last 18 months, and I guess from your perspective, I kind of curious to know, where do you see this going over now the next, the balance of 2024, and maybe as we head toward 2025, where do you think these interest rates are going to go?
It's interesting because today we're sitting here mid-November. There was a CPI print this morning, and the consumer price index, which is an index for inflation, came in, and it came in at or below expectations. So we've seen really this year a continued downward trend in terms of inflation. Inflation is coming down off of 9%, and it's in that 3% range right now. So that is a very positive sign. That is a positive sign that, the inflation's coming down. Typically it gives the Feds more comfort to not try to slow the economy down, because it's naturally slowing down from the 11 plus interest rate hikes that have happened over the last 18 months. So the interest rate hikes and increases are doing their job, it appears, naturally. With slowing inflation, supply chains are also running a lot smoother, which is helping with goods and services. So to answer your question, I would say that, my opinion would be that we're kind of in this phase of let's wait and see. Let's wait and see what the economic data continues to say and tell us. And that's what the Feds are doing each month. There is definitely don't see, 11 rate hikes coming. We feel that's behind us, and it appears to be doing its job. So I'm personally a bit optimistic that, we're in this phase of in 2024 around rates probably holding, with potential for easing at some point in 2025. So that's kind of our view. But again, a lot of things can impact that around the globe. This is not just a U.S. market thing. This is a global thing. But yeah, I would say that it's a great sign to see that inflation has been coming down, but yet, the economy is still keeping pace, which is a good thing.
Good. Well, appreciate that. And, I think, as they say in your world, past performance doesn't guarantee future results. But I appreciate you giving the feedback there. And it sounds like at least we've got some positive things that we can be looking at that maybe you're pointing toward a little bit of an easier road to hoe than maybe what we've seen over the last 12 months. So from a Stine standpoint, we have some information on our website about our financing options through John Deere Financial. But for growers who may be interested in learning more about John Deere Financial in general, are there any resources or anywhere you'd like to direct them to where they could learn more about the offering from John Deere Financial?
Yeah, a couple different sites I had mentioned, just basic information about John Deere Financial and agribusiness crop input finance solutions. You can go to mymultiuseaccount.com or Google John Deere Financial crop input financing. We've got a great site called inputfinance.com, where it allows you to look at that offers. And then there's inputfinancecalc.com, which really gets into the dollars and cents and making it easy for ag producers to really see how much interest expense savings they can generate for themselves using this very simple, easy calculator. They can compare cash discounts to finance options. So a really good resource that ag producers should really check out.
Awesome. And as I said, we have a range of options available from Stine Seed Company through our partnership with John Deere Financial. And certainly any of our sales reps can walk someone through the options that we have available. But anyway, David, pleasure having you on the podcast. I appreciate you being here and sharing some of your insights about this fast-moving market and the latest financial trends and how it's going to impact growers' purchasing power here this year and maybe for the next year to come. I appreciate you being here. Thanks.
Yeah, thank you for having me.
So that's our time for today. I'd like to thank our guests and our listeners for joining us on another episode of the Stine Seedcast. We'll be back again soon with more expert interviews and insights about all things Stine. And to never miss an episode, subscribe to the Stine Seedcast wherever podcasts are found.
Subscribe to the Stine Seedcast wherever podcasts are found. To learn more about Stine and its elite corn and soybean genetics, visit stineseed.com. Stine has yield.